What's up, Eves? Hope everybody is doing phenomenally well here this week. We have a lot to talk about here today, but before we go ahead and get into all that, of course, just want to address the recent kind of headlining news that's been going around lately about the former Bank of America associate, as well as the former 𝗪𝗏𝗽𝗀𝗪, Mr. 𝗪𝗲𝗪𝗀𝗃, who tragically passed away coming into this weekend here. So, of course, we here at WSO, this is kind of our thing. We wanted to see if there was any way that we could potentially help out the family or use our resources to some kind of good in just about any way that we could. So we've been working with a couple other groups and organizations and having a lot of discussions. I say it's all Patrick and 𝗪𝗏𝗪 and the rest of the team out there. So shout out to those guys for doing the right thing, the best that they can. And we officially now have a fundraiser going. So make sure to click on that first link in the Banana Bits in tomorrow's Peel edition to make sure that you're able to donate to that fundraiser. If you are able to donate, it would be phenomenal if you guys could. Of course, we don't expect much. The family even said any donation, regardless of the amount, they appreciate tremendously. So please check that out. Consider, if you are able to donate, please consider doing so, or please do so. It's for a great cause. It's going to mean a lot to the family. And what better connection to have than, a U.S. military service member as well as working in our industry. So feel free to go ahead and pay your respects in that manner. Let's go ahead and get into the news that we have to talk about here today for the Daily Peel. So I know it's been a while since I hopped on here. It's been a crazy busy past couple of weeks for me personally, so I do apologize. We're also going to keep this one relatively short because, in case you guys can't tell, got a big softball game coming up later for the Bad News Bears. Now, very important breaking news: the Bad News Bears are actually 2-0 in our last game, so that brings us to about 2-20 in the last two seasons, which ironically is also the standard fee structure of your average hedge fund. So I guess that's where we're all going to end up working once this softball team, once our professional baseball careers completely fall apart. But we'll see what's going on with that. Either way, WSO Alpha portfolio, very rough start this week. I mean, we were, for a brief second, a couple of weeks ago, outperforming both the NASDAQ and the S&P 500 for the year. We are officially now underperforming both because we fucked it today. It was terrible. Builders FirstSource and Disney are very much to blame there. Both stocks had earnings. They were down 16 and 10% respectively, so they completely fucked it. Both huge overreactions, if you ask me. We're also going to be coming out with a video on all of Big Tech's earnings tomorrow, so make sure to stay tuned for all of that stuff. And, we'll talk about how that's factoring into the Alpha portfolio and what you should be considering for your portfolio in the meantime as well. But for now, just know that the Alpha portfolio ultimately fell about 1.31% here today. The S&P 500 rose slightly. The NASDAQ fell very slightly. It was kind of a choppy, volatile day in markets here, but the Alpha portfolio is officially now up 8.72% for the year, which is still pretty damn phenomenal if you ask me. But, we are now underperforming the S&P and the NASDAQ, letting them get a little bit of a head start once again so that we can come back and reclaim the title towards the end of this year. We got to create our own comeback kid situation because that's what we're here about. We're always been on the underdogs here at WSO, and that's exactly what we're going to be doing this year. All right, moving into some of the other banana bits here today, much less important than the first one that we discussed. But first and foremost, Reddit just dropped their first earnings report as a publicly traded company here today. Shares absolutely popped after hours, so the IPO frenzy is over, but the earnings frenzy is just getting started. Be sure to check that out. Check out our video covering Reddit as well and find out why you should completely avoid that too there, in case you were wondering. But anyway, TikTok is also fighting back against the recent ban enacted by the U.S. Congress to effectively ban TikTok or force the sale of it here in the United States. They are fighting back. We knew this was going to happen. It's going to be a long, drawn-out legal process. So even though I believe they have about 270 days to work through a bunch of the bullshit around that and actually stop that ban or sell it to another company, I am sure this lawsuit is going to delay that actual ban date. So shout out to all of you TikTok fiends. You're probably still going to have it for quite a while. So, don't get too upset about it right now. Anyway, speaking of companies that we've covered in our report, what a surprise. Our take on Palantir was exactly fucking spot on. Who could have guessed? Now, the company, they did a really good job in their earnings report that they released just last night. So that's Monday night, by the way, because this is Tuesday at 8:18 p.m. that I'm recording this. So Monday night, they dropped this shit. Now, they did basically exactly what we predicted they were going to do. They had very strong fundamentals, but because the valuation had run up so high, the thing absolutely cratered on account of slightly weaker than expected guidance for the second quarter. So, if it's a reason like that, probably is an overreaction given that the sell-off is, so extreme. But once again, it's exactly what we said in our other videos, so feel free to go ahead and check that stuff out. All right, let's get into the big story of the day. We have credit where credit is undue. So we are talking about the recent consumer credit report that the Federal Reserve just dropped. Now, guys, We give out recommendations here at Wall Street Oasis. We just don't usually do it in the Daily Peel. It's typically going to be restricted to just our WSO Alpha subscribers. So it was a little weird for me today because we're now officially giving out a recommendation in the Daily Peel for the first time ever. Now, this recommendation, you guys have all heard of situations where you would beg, borrow, and steal to get out of it. You would do whatever you possibly had to do. Well, if your options are beg, borrow, and steal, our official recommendation is that you steal every single time, especially if you're playing a baseball game. Now, consumers, at least U.S. consumers, seem to be getting on board with this theft narrative as well, beyond all the fucking shrinkage that you see in retail stores and why literally everything from socks to fucking iPhone chargers is locked up in Target. That was actually two things that I bought at Target this weekend, and I was absolutely furious that I had to stay in there and call somebody over to hand me socks like I'm fucking shopping with my mom or something. But either way, consumers seem to be getting on board with this whole decreased borrowing kind of idea. And that's exactly what we saw in the Consumer Credit Report released by the Federal Reserve here yesterday. So they said that total consumer credit growth grew just 1.5% for the month of March. Yes, this is a little bit delayed. That 1.5% is well below what economists were expecting. Now, that translates to about $6.3 billion in total consumer credit increase. Economists were expecting somewhere more in the range of about $14.8 billion. This is also about half the growth rate that we saw in February as well. So clearly consumers are starting to pull back on their credit charges and what they're actually putting on the plastic. Now, there is a little bit of volatility in that initial chart that you'll see right there. Once you actually look at the piece and go ahead and look at these charts and then they start to make sense. Maybe I could put these charts on this screen right here, actually. That might be a good idea. We're coming up with ideas in real time here at the Daily Peel. Now, like I said, economists, they were way off in their guesstimate. Effectively, what's going on here is it seems to be finally a change of pace in how consumers are spending. So we haven't received the consumer credit report for the corresponding month just yet, but we have, I'm talking about the consumer checkpoint from Bank of America specifically, by the way. That is easily our favorite check on the health of the consumer. So once we have that over the next couple of days, and especially once we have the inflation reports, next week, both CPI and PPI are going to be dropping. We will have a much more kind of solid footing on the health of the consumer and know exactly what we can expect going forward, hell or high water, probably a combination of the two. The other big thing that we noticed here in another Bank of America report that dropped recently is that credit availability. This was a couple of months ago, or definitely a couple of quarters ago, this was one of the top concerns for a lot of small business owners, was the idea of even getting access to liquidity. But now, not a problem at all. So what does that tell us? Basically, this is a demand-driven problem. It's not really a problem, but the demand-driven trend that we're seeing right here. It's not because banks and lenders are not willing to give out credit. That is a terrible sign. When banks and lenders, who it's literally their job to give out credit, when they don't want to do that anymore, imagine the bar stops serving alcohol. Like, clearly there's problems going on here. That would tell us that banks see the economy as extremely risky. There's not really worth anything lending into. But given that, this is a demand-driven problem, that shows that consumers are effectively just changing up exactly how they're going to be spending that money. So with spending data, like we talked about yesterday, we haven't seen a strong pullback just yet. And that's largely due to these other charts that we stole from Bank of America down here below. So we have seen in early 2024 a bit of a rebound in wage growth for lower and middle class earners. That's obviously going to drive that because those are primarily the people who are buying shit on credit cards that they can't afford. And then we also have been seeing a relatively steady decline in excess savings. So given these additional liquidity options in income and excess savings, so if you're checking in your savings account, now that low and middle income consumers actually have money in those, they don't have to go to these interest rates anymore. The other big thing is that banks tend to use periods of low interest rates, or periods of rising interest rates, I probably should say, as an opportunity to send out like promotional cards. Basically, they'll say like, hey, I know rates are completely fucked right now. Go ahead and sign up for this card. For the first 15 months, there's going to be 0% APR. Then after 15 months, you completely forget about it, and that's where they start to collect their revenue on it. So that's another thing that could have been triggering this uptick in credit spending that we saw all throughout 2023. That's a big thing for these banks. Definitely don't underrate exactly how important that's going to be. The last factor, especially over the past couple of months, is, of course, tax returns. Now, the data that we're looking at from the Federal Reserve is from March. So tax returns don't impact that too much unless consumers were planning on having that tax return, which seems a little bit too advanced for the average consumer considering, the associated intelligence level with most of the people that I'm unfortunate enough to interact with on a day-to-day basis, and that are also misfortunate enough to have to interact with me. Nonetheless, that's the situation that we're in right now. It's not shit your pants territory at this point. The really scary part is that economists had ascribed a lot of this resilient U.S. spending to growth in credit cards. They've been saying, the only reason that spending has been able to hold up this strong is because consumers are putting it on the plastic and running up their credit card debt. Now, if that actually is the case, we know economists tend to be wrong about just about everything that they say. These guys would be like, I predict the sky is going to be fucking yellow tomorrow or some shit. Like, I swear to God, they're just addicted to being wrong. But we know that times, economic conditions, they are changing right now. To quote the famous, I was going to say Bob Marley, hell is his name, Bob Dylan, that's his actual name. Times they are changing, and we are just trying to adapt to it. If consumer spending slows, catch me in the bunker, and, hopefully I'll have room for you in there. Let's go ahead and move into some of the big stock movers of the day. First and foremost, we have Crocs. These are shoes that my girlfriend won't let me wear around her, but clearly everybody else as well, because the sales are popping off the charts. I mean, Crocs, they beat across the board. They beat sales by about 7.7%. They beat on EPS by about 34%, so doing a great job managing that cost and that operational leverage. Now, the only downside was that the Hey Dude brand, which is another pair of shoes that I own, there was relatively weak guidance for the second quarter, even though those shoes are drippy as fuck as well, and I can barely tie my own shoes, so it's great that we have that option, because all you have to do is kind of like flip them like a little knot kind of thing. Reach out to me if you need assistance with it. It took me a week to figure it out. Anyway, let's go ahead and move on down to our next big mover of the day. We have UBS Group AG. This is UBS, big bank out of Switzerland that just happened to marry their cousin, Credit Suisse. Generally, it's pretty ugly when cousins marry each other, both the idea of it and their offspring. But it seems like this marriage between UBS and Credit Suisse isn't as horrifically disgusting as we might expect. UBS, they popped 7% on the day after dropping their first earnings report of 2024. The big thing in the report was that net new assets in the firm's global wealth management division grew about 28% by $27.4 billion. So that was pretty ridiculous. Revenue grew 28%. Net new assets grew 27.4 billion. I don't know if I explained that correctly, but that's essentially what happened. Now, at the same time, they didn't take any hits to their kind of liquidity standing in creating that growth, because they actually improved their CET1 ratio from 14.1% up to 14.8% at this time. They beat across the board. Shout out to UBS. It was a great quarter for them, and they definitely deserved it. They swung back to profitability, as well as they haven't been profitable for the past 2 or 3 quarters. I forget if it's 2 or 3. I think it's 3 quarters in a row on profitability, given the ongoing merger with their cousin. But either way, let's go ahead and move into some of the stock losers of the day. Like I said, guys, we talked about Disney and Builders First Source at the very beginning being the, huge detractors on the alpha portfolio of the day. So, of course, our first stock to talk about is, of course, Disney. Shares were down 9.5%. Really, the big thing in this report was that the company swung to a loss for the period. They lost about 1 cent per share on a GAAP basis. Now, on a non-GAAP basis, they did beat on EPS and sales, but very marginally. The GAAP loss comes from a goodwill impairment charge that they had to take for this quarter that's related to their Star India brand. This is essentially like basically it's kind of like ESPN, but for India. It's a little bit different. It's more kind of like focused on these leagues. But effectively, Disney and their streaming providers over there, they lost a lot of the content rights to some of the most important cricket leagues. So they said, fuck all that. If you're not giving me my cricket, I'm not giving you my money. And that is something I can totally understand. Total revenue ended up growing 1% for the year. So, like most of Disney's recent movies, the report was very disappointing almost across the board. But, the parks business was still holding up very strong. Thank God they have that thing, because Disney Plus, they cannot figure out how to make this profitable whatsoever. They're very close to profitability in their streaming business. They're saying Q4, they're going to actually achieve that point. I'll fucking believe it when I see it, Bob. Let's see. All right, moving on down. I swear I can still talk. We are going to be talking about another holding within the WSO Alpha portfolio, and that is, of course, Tesla. This stock was down 3.8% on the day because, surprisingly, I couldn't believe this, but Elon Musk's tactic over this weekend of begging Warren Buffett to buy shares actually didn't work out. At least as far as we know, 𝗪𝗏𝗪𝗀 has dropped. We don't know if Buffett is making, going in size into Tesla like Elon seems to think he should. But in addition to begging Buffett for his investment, Musk, he kind of got slapped in the face today because the China Passenger Car Association, this is like an auto data provider in China, they reported this week that sales of Tesla cars fell about 30% monthly and about 18% compared to April of last year. Still, that fall of 30%, I mean, I think the big sell-off here came because we had expected that weakness in China from the consumer, especially with these durable goods purchases like vehicles, we'd expected that most of that weakness was behind us, or at least the worst of that weakness was behind us. Clearly, that is not the case, falling 30% in just a single month. What that means for the broader economy over there, we don't really know. We also know China, they do not like American brands being big over in China for the most part. It has been a thing in the past, especially with companies like Apple, Nike, and now Tesla. But don't be surprised if the CCP strongly discourages purchasing American brands, even though Tesla did just they got some sort of like data security clearance where they can, have autonomous vehicles in China as well. Absolutely insane if you ask me, but still down about 3.8% on the day. All right, now to finish it up, we're going to be getting cute with Q2 earnings right here. I apologize for that cringe that you absolutely just felt right there, but nonetheless, it sounds pretty similar. It's like borderline alliteration, so let's go ahead and get into it. Most of the time, analysts, they're fucking depressed. We all know that. You know that. I for sure know that. And it's kind of hard not to be depressed when your job is literally to find problems with everything that you look at and try to optimize, in order to optimize your recommendation or an investment portfolio, the whole goal is to identify problems. So when you're paid to identify problems, it's kind of hard to be optimistic. Nevertheless, analysts are apparently feeling pretty optimistic here going into Q2 earnings. We're still far away from the beginning of Q2 earnings season. We're still in the middle of Q1 right now, but FactSet has this really cool measure where they track the change in EPS estimates for the collective S&P 500 on a monthly basis. So they'll say analysts have increased their earnings estimate for the S&P 500 by this much, or they decreased their earnings estimate for the S&P 500 by this much. So the month of April, it's the first month of Q2, and analysts, typically what they do, the 20-year average, is that they will typically downgrade or, kind of lower their EPS estimate for the current quarter by 1.8% in the first month of that quarter. Now, April was the first month of Q2 2024. On average, typically they'll downgrade by 1.8%. Fuck that, analysts increased their rating by 0.7% this past April. This was actually the first uptick in an EPS estimate since Q4 of 2021, which also happened to just lead into 2022, where the S&P fell by about 20% or so. But don't get too scared just yet, because there's a lot of different reasons that analysts could be increasing their earnings estimates. It could just be overall general euphoria, like it was in Q4 2021, or it could be actually fundamentally driven. Now, if we break it down and take a look at the sector level, we can start to see exactly where a lot of this EPS estimate growth is coming from, and it's entirely from the energy sector. So 7 of the 11 S&P 500 sectors actually got an increase to their own EPS estimates, but energy was at 8.6%. The second highest was communication services at 2.3%. So they almost quadrupled the second highest. Now, breaking it down, we can start to understand exactly why that is. Management commentary on these energy companies so far has been relatively constructive for Q2. And when I say relatively constructive, I mean more constructive than analysts had expected. Keep in mind, it's never about good or bad in investing. It is all about better or worse. So this is just things getting better. And although oil prices have remained relatively flat, natural gas prices have skyrocketed in the past couple of months. Very strange to see that heading into the warmer months, at least here in the Northern Hemisphere, but nonetheless, natty gas contracts are up about 135% in the past couple of weeks. That could be a big reason why, because obviously the higher price is going to lead to an increased margin or a greater spread on that revenue. So that's kind of the main stories for us here today. Once again, guys, please go ahead and check out that donation. If you're still watching at this point, you are officially a dedicated, very wise ape. And in that case, you're like the number one person that should consider donating to something like this. Once again, it will be very beneficial for their family. It's a great way to honor a heroic service member of the U.S. military. So feel free to go ahead and check that out. With that said, let's finish it up with a John D. Rockefeller quote for the day. He said, "The person that starts out simply with the idea of getting rich won't succeed. You must have a larger ambition." I'm completely fucked if that's the case. I hope you guys have some kind of a larger ambition. And I also hope you guys have a wonderful rest of your week. I will see you tomorrow. We are back to our regularly scheduled programming, barring, anything like last week. But we'll see exactly what's going on. I will see you guys tomorrow. Happy investing, happy trading, and bye now.